Welcome back, students. So we'll start off part B of this video by first talking about the S&P 500. What is it? The S&P 500 is the 500 largest companies pretty much in the world, minus maybe one or two Chinese companies, right, as of now. But it's the 500 biggest, baddest companies in the world, all right? And what is an index? An index is basically it's a collection of these S&P 500, like what you see right here. Let me zoom in a little bit. Currently, as it stands, this list you see right here in front of you is the current list of the 500 biggest companies. All right, the 500 biggest companies. Now, why do we care about the 500 biggest companies in the world? We care about the 500 biggest companies in the world because in slang, right, in Wall Street lingo, when we say the market, the market, the market, we're usually implying the S&P 500. Why? Because the S&P 500 collectively makes up a majority of the stock market, an overwhelming majority of the stock market. That's why we talk about these 500 companies. So then your next question will be, okay, then, but why not take all the stocks in the market? Reason we don't take all the stocks in the market because these tend to be the most stable and profitable. So not only do these companies represent majority of the money in the market, they also represent the most stable of the companies and most profitable of the companies in the market. Somebody once, analyst asked me, why not the Russell 2000? The Russell 2000 is another index that has 2,000 of the biggest stocks. Because literally after the first 500 stocks, the size of the companies and the importance of the companies goes down exponentially. That's why. And you don't want, and a lot of times for Wall Street analysts, we don't want these smaller companies with their higher volatility in prices to affect the overall index, which they won't. They really won't. So the reality is that they have a negligible effect on the volatility of the market. More importantly, they don't represent the stability in growth and earnings that these 500 companies do. So that's why we always focus on S&P 500, S&P 500. Now, if you follow the news in any kind of financial media, what do they always talk about? The Dow. Why do they? First of all, the Dow's not even a real index. So why the Dow? It's what we call it. It's a price index. So why do they always talk about the Dow? First of all, the Dow is only like 30, 40 companies, right? Second of all, the way it's structured, it's not structured by market share like the S&P 500 is, right? At any given time, the company that has the most weighting is the company that has the largest market value. And shockingly, for some reason, Microsoft right now is higher than Apple. But you see which companies go head to head with each other in terms of market share. It tells you something about our economy, by the way, when you see which companies are vying for market share. So in the Dow, it's done by basically a share in the price, right? It's not by market share. It's some sort of other funky factor, which leads it to be much more volatile. The index moves much more, it moves more frenetically. And because of this is exactly why the media companies, they tend to focus on it. Because, again, these media companies, they're businesses unto themselves, right? And if there's no news, they can't really make money. So the Dow index just generates more news for them because there's more volatility. The S&P 500 obviously is a lot more stable. In reality, no investor looks at the Dow. We all look at the S&P 500, right? So that's what the S&P 500 is. That's basically what the S&P 500 is. So when we talk about the market, we talk about the S&P 500. Now, given that, what is SPY? SPY, like I said before, is an exchange traded fund. What is an exchange traded fund? An exchange traded fund is basically a portfolio of stocks that is on the stock market, that is listed on the stock market with a particular ticker that you can buy. So what does that mean? What that means is that there's a ticker that if you were to buy a share of that ticker, you're effectively buying all 500 of those companies. Obviously, in very, very small amounts, right? But nevertheless, the underlying, that share is actually representing 500 shares, 500 very, very small shares in those companies. And there's all kinds of these ETFs in the market. There's all kinds of these ETFs in the market. There are ETFs that represent 2 stocks. There's ETFs that represent 10 stocks. There are ETFs that represent a particular industry. There's ETFs that represent a certain region of the world, right? You can invest in stocks in some of the top tech Korean stocks via an ETF here in America. So they have all kinds of ETFs. They have some ETFs that mimic some hedge fund strategies, right? And the beauty of these ETFs is because they're freely traded on the market, like on MarketWatch, you could buy SPY or some of the other S&P 500 ETFs via the MarketWatch, right? Or through Ameritrade or through Robinhood. The brilliance of this is that what we call the management fee behind it is incredibly small. What's the management fee? For your parents that invest in mutual funds, first of all, why are they still investing in mutual funds? Those mutual funds are managed by private financial companies, right? Like Prudential, Merrill Lynch had a lot, JP Morgan, all these guys, they have their own mutual funds, right? But mutual funds is going the way of the dinosaur. Going the way of the dinosaur because the management fees for these mutual funds were really high, right? Not really high, but they're relatively high. Whereas the management fee for these ETFs are so low. They're so low. And we'll talk more about management fees in the next lecture, right? But basically, basically when I mean that the management fee is low, it means that overwhelming majority of your money, like 99.9 something % of it, is actually going into the actual stocks, the underlying stocks, versus somebody's pocket, right? Versus somebody's pocket, some company's pocket for managing it. So that's what the SPY is. The SPY is an exchange-traded fund that you can freely buy and sell in the market publicly on the stock exchange, and it represents literally all 500 of the biggest companies. This is the ETF, guys, that I tell my students that, look, if you have no interest in investing, like at the end of the semester, you might be like, oh, I don't care about investing. I definitely don't care about investing the style we learn in class. And that's that. That's fine. But this is the ETFs that I tell my students that, hey, listen, every time you get a paycheck, take a small percentage of it and buy some S&P 500 ETFs, irrespective of the price. Just buy it. And do it regularly on a schedule. Just keep buying it. Every 2 weeks, boom, paycheck, certain percentage. I have some past students, I have some alumni that they have their paycheck and their stock account automated in the sense that the direct deposit happens, automatically direct deposit happens. A small percentage of the direct deposit goes to another bank account, which then automatically puts their money into their brokerage account, which then automatically gets invested into, when the market opens, into the S&P 500. Boom, without even thinking about it. And look, even in scenarios, again, with this pandemic, you see that the government goes out of its way, rightly or wrongly, to prop up the stock market. So even when it tanked, hopefully people were buying it, the S&P 500, and they got a great price for the S&P 500. And as you can see, it just keeps going higher and higher and higher. Eventually it has to come down, and it will come down. But in the long run, it'll keep going higher. And that's what it's really about, right? In the long run, you're slowly building up this portfolio. Again, not even thinking about it, of the top 500 biggest companies. And again, we'll talk about this later in the next lecture when we talk about passive and active investing. All right, so that's what we're going to basically invest in. And how do we go about calculating this? Well, if you recall, all right, now here in let me just make a breakout point. This is the actual Lab 2. Lab number 2 solution. And now basically, guys, look, we have this scenario again, if you remember, where I'm doing the first scenario here, guys, with the freshman, all right, with my hypothetical student. So if my hypothetical student, look, we're in June now. So let's say end of May. So let's say they graduated at the end of May, right? Like a few weeks ago. So that means that this student started college in 2016, my fictional student. So 2016 to 2017, 2017 to 2018, 2018 to 2019, 2019 to 2020. Yes, to 2016. So this student in, let me comment this out, in September of 2016, and again, I'm following my fictitious student from my my lab one. They put 11,000. They bought $11,000 worth of SPY ETFs. All right, they bought $11,000, whatever that was, of SPY ETFs. All right, and then again in 2017, they bought another $11,000 of ETFs. Just copy and paste this. In September 2018, they bought 11,000 ETFs, and in September 19, okay? So this represents the 4 points in time that they bought $11,000 worth of SPY ETFs. Instead of going to Rutgers, instead of giving the check to Rutgers, they gave it to, they opened up a brokerage and they put their money in there. So they invested all in these 4 years, $44,000, all right? Now, when are they cashing out? Firstly, we have to make an assumption here. When in September did they purchase it? We will say the first transaction date, to keep things simple. The first transaction date of September, they bought it. All right. So first day. First day. And again, what I mean by first day, I mean the first trading day of September of these years. They went out and bought these. They bought these SPY ETFs. Done. Now, they have this portfolio. When did they cash out? So when did they basically represent? So what is going to represent the fact that they got their first year salary? Now, granted, when you guys start working, you don't get your whole compensation the day you graduate. It gradually happens over the year, right? It gradually happens over the year. So, but in our case, we'll cheat and we'll just say, look, this student got their payday on graduation, or in this case, the end of they cashed out in May of 2020, end of the month. This time they did it the end of the month, or the last day of May 2020, the last trading day, right? And they cashed out. All right, so they basically sold all their shares at the last day of May 2020, right? Now the question is I have for you, my students, what was their compound return? What was your compound return? This is basically lab 2. This is actually, I would say, part A of lab 2. Part B of lab 2, like I said before in the previous video, we'll calculate it. I will try to calculate more for what currently is your compound return. So as in so far, basically if you're a rising junior or a rising senior, on the numbers we have so far. So we'll calculate that, right? So we'll say this is part A, and we'll do part B. We'll adjust this to do part B. Okay. All right. So how do we go about doing this? Now, obviously, I have the solution, right? But what's the logic that we're going to use to get that solution? The logic here is, how do we go about calculating this, getting compound return? There's 2 steps that basically really need to happen. What needs to happen is I need to first get to the point of how much money did I invest, right? And which we know I invested 11,000. That's part of the equation we understand. I invested basically 11,000. So let's recall our compound return formula. So I invested 11,000 in 2016, and that'll compound for 4 years, right? This R represents what our compound return is. This R represents what our compound return is. And let me cheat a little bit here. All right, hopefully your practice set questions kind of help you gauge what needs to be done. Right, so I have 11,000 I invested in my freshman year or 2016. This student invested another 11,000 2017, another 11,000 in 2018, and obviously another 11,000 in 2019. That was only for 1 year, right? So firstly, notice that we're doing year on year, but we're cashing out on 5/20. That's not really a full year. It's not really a full year in this example, right? But I'm trying to keep the math simple, right? Because really, if I invested this 11,000 in 2019 for 1 year, I would be cashing out. And all of these guys, I mean, if we really kept it year by year, we would really be doing the price for 9/2020, the first day of September 2020. The reality is we don't have that price. So here we're suspending reality slightly, and we're cheating a little bit, not taking a full year's worth. We're just taking the end of May 2020. That's okay. That's okay. It's not going to be a full, proper compound return, but it'll be close. It'll be close for gauging it. All right. So there, I just wanted to point that out in terms of math. Some of my math students would have figured it out already that we're doing that. I mean, we could actually alter this equation, and instead of figuring out annual compound return, we could figure out monthly compound return, and there we can get an exact answer. Do it month to month versus year to year. This is fine for now. Year is fine because a lot of you guys are beginners. Okay, so this equation needs to equal whatever my final portfolio is, my final value of my portfolio. The final portfolio, can't spell, value. All right, whatever my final portfolio value is. Once we set up this equation, we can then back out using, once we have this part right here, ladies and gentlemen, once we have this part, then we can calculate what this part is using what? Using the same code or logic that we did in lab 1. All that requires in this lab that's different from the first lab is that we have to go the extra step to figure out what the final portfolio value is. In our first lab, we made the assumption, at least I made the assumption for the first part of it, that it was 65,000, right? Now, I need to figure out what this final portfolio value is going to be. Everything else is pretty much the same setting up the problem, but I don't have what the final portfolio value is. How am I going to get that final portfolio value? That final portfolio value I can only get by calculating what each one of these investments were, what they became, right? So when I invested 11,000 at this point in this point in time, what was the price at this point in time? What was the price in this point in time? What was the price of this point in time? What was the price in this point in time? And then what did it grow into? So how do I do this? A simple trick, guys, is to simply calculate the return of the stock and then multiply that return by the initial investment. Same way we do these tricks over here, right? Same tricks over here. So for example, let's say, actually not even let's say, let's go ahead and get the actual prices for SPY, right? Let's go ahead and get the actual prices for SPY. What am I going to do? I'm going to do get symbols, SPY, boom, done. As you see, SPY popped up over here. Fantastico, fantastico. All right, now let's do our first example. Let's actually do it by hand so you guys know what I'm talking about. All right, let's do the first example by hand. So what was the price of SPY in the first transaction date of September of 2016? You guys know how to slice by dates now, don't you? Right? Firstly, let's go ahead and filter SPY by just the 2016-09. Boom. All right, you see all these prices here. Okay, now which price do we want? Right, we're always going to look at, notice the prices are slightly different, guys. For SPY, it always tends to be slightly different. We got close, we got adjusted here. Which one do we want, guys? All right, which one do we want? In this case, let's take, let's take the adjusted here, guys, just so we get the proper returns. All right, because I want to make sure that the data is uniform. So we're going to take the 201 price versus the 217 price because look, we're going to be doing math over time. We want to make sure numbers are consistent. So this is the price we want right here. The first transaction date of 2016. How do I get that? Okay, no problem. So I can do this two ways. I can say, hey, I want just the adjusted close price, right? I want the adjusted close price, but I also want just the beginning of the month. I don't need all these columns. Which other function could we use, guys? That's right. First, I don't need to give any additional parameters because I just by default first will just give me the first value. Boom. You see how we did this? We added more specifications to that data container, slicing and dicing through another first function, and we honed in on the price we wanted. Right? We honed in on the price we wanted using the same logic as in the first part, as we did in part A of the video. All right, and now we got the price I wanted. I want a clean price, so I'm going to go ahead and use the as.vector function. Ta-da! That's it. In the beginning of September of 2016, that is the price I bought SPY at. All right, that is the price I bought it at. Now, what I want to do is I want to calculate the return just of that share of when I hypothetically cashed out, this student cashed out. And then I'm going to take that return, which is a simple return. It's not a compound return now. We are calculating a return, but notice we're going to be calculating return over time. In this case, like 4 years. And we're going to apply it to that 11,000 to get a final value that's going to be not a compound return, but just the simple portfolio value or partial portfolio value of that particular investment. Right? The logic here is, hey, if you put $100 into an investment that gave you 10% return after 10 years, what's the final value of portfolio? $110, right? The return plus your initial investment. It's $110. That's the logic we're applying here. We're trying to calculate the return, the simple return over time that we can apply to the 11,000, see what it grew into at the end of that period, which I'm cashing out, which is the end of May 2020. All right, so we'll call this my what's the logic I use in my slides? Fine, I called it fresh, whatever, I'll call it F buy. Slightly different, guys. F buy for my fresh and buy price. All right, F buy for fresh and buy price. Done. So I take everything I did and I just stored it into that data container. We can do this as well using the AD function, and I will show you that as well right here. It's going to give me the same values, but why not? SPY dash 2016 dash 09 gives me all the data for that month, that particular month. I just want the adjusted column, so now I'll use the function. So here I'm doing it the different ways. The other way, in line 55, I did the grid method. Here I'm going to use the actual AD functions. Boom. So now I just have that column. And I will just want the first row of that column of prices for September of 2016. Boom. Same thing. And as well, I'll put this in. All right. Oops. And as you notice, we get the same values, guys. Everything else is the same. Same. All right. So either 55 or 56, it's all good. It's all good. You can obviously, when you're coding, guys, you can do things. You can code the same thing in several different ways. It's fine. All right. So I have my buy price. What's my sell price? Now, my sell price will be the same value for basically all of them. They all have the same sell price. All of them have different buy prices at different points in time, but I only have one sell price because we're selling all my investments, my 4 investments, in one shot. Alrighty, so same way, I'm going to do it again, guys. I'm going to do my logic the same way. SPY When am I buying? I'm sorry, when am I selling? I'm selling in May of 2020. 2020, sorry. 2020-05. Boom. Now I have the 2020 prices for SPY for 2020. All right, for 2020. Okay, now here I'm going to, again, I'll just do it one way this time. This gives me just the close prices, and I just take the first row from the adjusted close column of May. Boom. And we want this as the, remember, this is coming back as a XTS data table. I want that number, nice and clean number, as a simple vector, so that aesthetically my calculations look perfectly fine. So I'm going to do the as.vector. All right, and oh, sorry. Slight mistake here. I put a first here, guys. Do I want the first transaction date of May 2020, or do I want the last day? The last day. So I don't want first here. I apologize. I don't want first. I want last. Use the last function. And now, I should have caught that over here. I just saw that when I went down here. I don't want the first. I want the last. And now I have the price. All right. Again, notice higher SPY, market's going up. We have record amount of unemployment, yet the market's going up. What does that tell you about the stock market? Totally decoupled from the real economy. The financial economy is getting more and more decoupled from the real economy. This largely has to do with the fact that our government, like I said before, has we've become corporate. Our government, the Congress, has become basically taken over by corporate socialists. That's pretty much no way to put it. The executive, the legislative branch have adopted the policy of not capitalism, ladies and gentlemen, not socialism, what Bernie was selling, or democratic socialism, but corporate socialism, which is not good. It's not really good. But anyway, continuing on. So we have our price. So now I'm going to just put this in a variable. I'll just call it sell. That's fine. So the sell variable will have our sell price. Okay. Now, what is my return going to be? My return is basically going to be, what's the formula? Okay, so what's the formula for calculating a return? We're here. I don't know if we talked about this. We didn't explicitly talk about this, did we? The formula, I should put this right here. The formula for calculating a simple return is your sell price divided by your buy price minus 1. And that's how you get the return. Simple return using asset prices. Simple return using asset prices is basically your sell price divided by your buy price minus 1. That is the formula for a return, a simple return. Okay, so an example here would be if you bought a car for $100, you sold that car for $200, what's your return? It would be basically your sell price, 200, divided by your buy price, 100, minus 1. So that would basically be 2 minus 1 gives you the answer 1. That 1 represents, remember, it's a percentage, so that 1 is actually 100%. Another example would be if you bought and sold a, I don't know, textbook, right? Textbook for 20 bucks. You bought it for 20 bucks. You sold it for 25 bucks. All right. So what would your return be? 25 divided by 20. Oh, let me bust out with some math here. So 25 divided by 20 minus 1 will give you a 25% return. So you have a 25% return from buying and selling those stuff, that textbook. That's what a simple return is. Boom. Not to be confused with compound returns, because compound returns are basically the average returns over a certain period of time, year over year, quarter to quarter, month to month, whatever, over a certain period of time, right? So it's more or less, people like to think about it like the average. The average. It's not really the average because it's compounding over time. But a simpler way to think about it is basically the interest rate in a bank account. You put your money in a bank account at a certain rate, monthly or annual rate, and you just let it ride for a certain period of time. That's basically what compound return is. All right, so now here, that's a simple return. So what's our return for our freshman year? Our return for our freshman year is basically going to be the sell price divided by the buy price for our freshman year minus 1, which comes out to, I apologize. Let me run this one. I never did the as-dot vector for line 56. That's why that happened. See how the results came back as an XTS data table? That's exactly what we're trying to avoid. And that's because I did line 56 and I never did it as-dot vector. All right. Excellent. So now this should work fine. And I noticed I got a simple number. All right, excellent. So our return, right, if we just bought one share of SPY at that in the beginning of September 2016, sold it as of the end of May, we got a 50% return over those 4 years. That's not bad, or almost 4 years. That's not bad. That's not bad at all. Got about a 50% return here. All right, excellent. So that return now, I'm basically going to apply back to the 11,000 to see what my final value is. So if you invested $11,000 in this asset, and it gave you a 50.568 return, what is the value of that investment now, guys? We apply the formula. So it would be basically my freshman return, and then we would simply do 11,000 times 1 plus my freshman return, and this gives us $16,574.92. So my 11,000 basically went to $16,574 by the end of May. That one particular leg of my investment became $16,574. So that's part of my final portfolio value. All right? Do you see that? And now we have our first part of 4 parts of answering this question. My first part of the 4 parts. So this part right here, this investment right here, right? This is actually obviously going to be is going to be the summation of lines 45 to 48, and the first part, line 45, came out to this amount right here. That amount right here, and we will go ahead and save that as and we'll call that. Let's see, what variable did I use to save that? I saved it as. Oh, we did the math all in one shot. All right, fine, whatever. I'm now going off the rails a little bit, but that's fine. All right, so this became 16,574. All right. Now, what we need is, we need the other 3 parts. We need the rest of the equation to get my final portfolio value. So how do I do that? Now you guys know how to do this. Let's unleash it a little bit. All right, so now we have our freshman buy price. Let's get our sophomore. Let's do SBuy for sophomore buy price. I'll just pick one particular one of these and do it now. All right, now our buy price for our sophomore year was 2017-09. For junior year, it was going to be 2018-09. And our senior year is going to be, I'll say SE for senior, 2019-09. So same way I got it for my freshman year, I'm now doing it for my sophomore year. Change the date. Junior year, senior year. Excellent. And you can see that senior, junior, and senior. So I'm sorry, sophomore, junior, senior. Okay? All right, the sell price is still going to be the same. They all will sell at the same price. They're all going to sell at the same price. So now I can go ahead and calculate my returns for each one of these. My sophomore return, It's going to be my cell divided by sophomore buy. My junior return will be my cell divided by my junior buy price. That's my junior return. And my senior return is going to be my senior, the sell price divided by the year I bought it, the price I bought it my senior year. And that's how I have the returns for those other $11,000 investments I did at different points in time. And now I could come down here. I'm sorry, did I delete something? I think I deleted my original equation. All right, that's fine. Oh no, sorry, this is what I wanted. Take that. Should have moved that down. Sorry. Let's delete that line there. So now we have more uniformity. It makes a little more sense. And now, if I want the final portfolio value of all 4 of my investments, I now do 11,000 times 1 plus my sophomore return plus 11,000 times my 1 plus junior return plus 11,000 senior return, right? I press enter. What is my answer, guys? What is my final portfolio value for those 4 years that I invested? Okay, and let me just check to make sure if all the math is correct here. 50%. Senior year, junior year, and senior. I'm sorry, sophomore, junior, senior. Excellent. Okay, so when I do this right here, I come out to $54,477. All right, $54,477. Right off the bat, is that amount smaller or greater than the amount of money I invested? All throughout time, I invested 44,000, right? 11,000, 11,000, 11,000, 11,000. This amount is higher. Excellent. So this amount, so my compound return will end up being, remember the equation right here, we want to solve for. This final portfolio value right here became this $54,477. So this R, the compound return right here, right? It will be positive. It will be positive. That's a good sign, right? But is that 54,000 less than or greater than my 65,000 that I used for my fictional scenario? It's less than it. The compound return for investing in the market versus going to Rutgers Business School is going to be less than the 16.2223% compound return. It's going to be less than that. Okay, we already know it. All right, so what is the actual answer? Let's get to work now. Final PV, this is the final portfolio value. All right, so now I have that number in that variable. And now we're going to calculate a compound return. How will we calculate our compound return, guys? You know how we're going to do it, because now this is turned into lab 1. At this point now, we have now turned this into lab 1. Let me take the equation we want to solve for. We're going to make this into a function, just like we did with lab 1. We'll call this lab 2 equals function R. Notice the R variable here must match these variables here. Always make sure you don't make that mistake. You know, even on the exam, hint, hint, wink, wink, shrug, shrug. All right. This is going to be some sort of value. This has to be solved for. We have to return the value so that Uniroot can use it, and we're good, right? We're good, right? The function is good to go, yeah? No. What's missing, students? When you use Uniroot, Uniroot solves the function for what value? It solves the function for 0. Is this function written in a way to be solved for 0 to give us the answer? Nay, it's not. What are we missing? subtracting the value we want this equation to equal. We want the equation to equal the final portfolio value, so that the function will be solved for 0. We want the R that'll solve this function for 0. Remember that. We want the R that'll solve this function for 0 because uniroot always solves functions for 0. All right, so now this function is good. Now this function is good. All right, now we can use uniroot. I'm just storing the results for uniroot right here, guys. Remember, RES will turn into a list, which is a container of containers. So uniroot, the first parameter is your function you want to solve for. The second parameter is your starting point. We know the compound return is going to be positive. We already discussed that, right? The final value is greater than 44,000, so I can start off with 0. That's fine. I don't need a negative number. And my upper bound is going to be, it's not going to be as high as my other compound, my education compound return, so I'll keep it at 50%, even though I know it's not going to be that. I run this, and I do res $root, and we got our answer. The compound return, ladies and gentlemen, the compound return of investing in the market for my student, hypothetical bait student, as opposed to going RBS, getting their bait major, having moi as a professor, right, was 8.7% return. Ladies and gentlemen, this student, and some of you, can now go to his parents, his family and friends, and say, thank you. Thank you for pushing me to go to RBS and having Professor Waj as a professor, because I actually almost doubled my compound return by going to Rutgers instead of investing the money and investing my money in the stock market. Ladies and gentlemen, an education quantitatively does pay, and you've just proven it. I'm clapping if you can't hear it. You've just proven it. For at least this case, you've proven it for this student. RES $F root. Let's see how close we got it. So here we got it to, that's kind of ugly. We got it to about negative $3.5, negative $3.50. What this means is we didn't get an exact answer. We didn't get a precise answer, but that's okay. We're off by like, I don't know, we're off by like negative by $3, $4. All right, so we round up anyway, so it doesn't really matter. We're going to come up to 8.73% return, so it's all right, right? It's all right either way, right? So here, guys, you got, ladies and gentlemen, you got your compound return. You got your answer. You got your answer for this, for the first part of the lab. Now, this is for my fictitious student. For you guys, you want to figure out what is your compound return as of now. So what we could do is, let's see, if I'm a rising senior, how am I going to change this? If I'm a rising senior, I have my freshman year I bought, I have my sophomore year I bought, I have my junior year, and I have my senior. You have your senior year as well. Your senior year? No, because you guys are in summer session. All right, so we'll exclude summer session, what you're paying for summer session, or you could factor it in. I leave it totally up to you guys, but I'm looking at it from the point of view of a senior that's not in summer session. But you could factor in. You guys can always add that, pad that to the beginning, to the end of your junior year tuition or the beginning of your senior year tuition. I leave it up to you guys. So, but you do have your freshman year hypothetical, your sophomore year hypothetical, and your junior year hypothetical. And for my rising juniors, you can adjust it as well if you wanted to. So I have my, let me steal this. I have my F by sophomore and junior year. I'll take that. And now I'm going to say this is Lab 2. Part B, rising seniors. Okay, and now guys, what you can do is, you still bought, we'll still assume you bought at the freshman year or sophomore year, done. We'll still assume you bought sophomore year, that at that amount, done. Junior year, that amount, done. Okay, so now the question is, what purchase price you use? What's sell price? So that's what's really going to change it. What's our sell price, right? So the sell price we're going to use now, guys, is instead of using actually I'll do that right here. Instead of using um, the sell price for May, I'm going to use my most recent price, whatever that is, whatever that might be. So if I do last SPY, if I just do last SPY, I get the last trading day, which turns out to be June 1st. Done. I want the adjusted for there. And notice how I do the adjusted function. I have the last function inside and they have the adjusted function outside. It's fine. They're interchangeable, the order. But the order will change how you get the results, but a lot of times you end up at the same place. You just get there differently. So this, I'll apply the adjusted function. I have my adjusted price. And remember, I just want a simple vector because I want the simple output to look simple with simple containers. I have that price. So my sell price will literally be the most recent price. And it's because I'm doing this right now, right? You guys can mess around with this at different points in time. Boom. All right. So, I mean, that's basically really that's one of the two tweaks we really need to do. So now I'm going to go ahead and do these returns. Notice I don't have a return for summer. But again, you guys can factor that into your, I'll show you where you guys can put in your summer classes prices. So here I will have now, this is now different. So these returns will be different and we'll see that. See that now it's slightly different, right? So you guys can see now how the numbers have slightly changed. Not really that much. All right, so now here is when you do your function, it'll change. So if I do lab2b, copy and paste, that's fine. So here's where it's going to really change, right? So here, it's now going to be t equals, and now you're going to put now here you put your own tuition. I'm still going to use that fictitious 11,000 because I just don't know what your tuition are. All right, so it's 1 times, and here you guys would actually put your own tuition in. Make sure part A works first before you do part B. All right, so now you would do 1 plus R to how many years has it been now? Right now we're at how many years, guys? Your freshman year. Oh, I'm sorry. I made a few more mistakes. Sorry, I apologize. Go back. We have to make another change. I just realized this when I saw the year we're adapting. If you're a rising senior, when did you come to school? 2000. I believe you started 2017, correct? So 2017, 2018, 2018, 2019, 220. Right. So you guys are actually, my rising seniors, your freshman year is 2017, your sophomore year is 2018, your junior year is 2019. This coming fall will be your senior year at 2020-09, right? That'll be your senior year. So here, that is the change I need to make. I apologize. Some of you guys probably already caught that. So now let me go back, recalculate this. Let me make sure the numbers are now different. Freshman year. Excellent. So it's slightly different now. Sweet. All right. So here, good. We figured that out. Now, right now, we are technically around not 4 years. You've invested your 4 years. Remember, you're heading into your 4th year. So right now, as of this fall, it would be invested in for 3 years. And again, it's not exactly 3 years, but hey, you can go back and adjust the ratio if you want. You can adjust this. You can do a little math ratio right here by how many months of the 252 days, or if you want to do 365 days or whatever, you actually invested. You can figure that out. That's fine. But we can keep it simple. So 3 years. Your freshman year is 3 years. So this is the adjustment, the other adjustment that needs to be done I was talking about. Your sophomore year has been for 2 years, and your junior year will be for approaching 1 year. All right, this now, ladies and gentlemen, we have to do the final portfolio value, right? And to change this up right here. So this right here, guys, became no senior year. So this is now freshman, senior, sophomore, junior. And now notice your FPV will be slightly different. All right, 38,000, not bad. Still positive. And for you rising seniors, as of the closing day of, I believe, not today, as of Monday, all right, lab 2B, we'll throw a return in there. All right, and now we're going to do our second result. Result 2 equals uniroot lab 2B and it's going to be lower is going to be, we'll do 0 because we know it's positive, upper 2.5, and my answer, ladies and gentlemen, or for my rising seniors, about 7.29%. 7.29%. So far, that is what your I'm sorry, that is not, obviously that's not how much money that's not the compound return of your education, but that is hypothetically, if you want to compare what your compound return is so far, that is basically your benchmark. That is what you're comparing it to. Let's see how close we got the result. How good it was. Negative 23 cents. All right, sweet. Negative 23 cents. Sweet. Even closer than before. All right, so that is how you do part B. Now, I'm going to throw another part in here, right? So at this point, guys, you guys put your own numbers here, right? Everybody, even my rising juniors adjusted even further because you only have 2 years really of investment, right? So adjust these numbers, calculate your own compound returns, right? Calculate your own compound returns. Now I'm going to do another part C, and I did this in my slides. In my slides, I reran the calculations, but this time I ran it for one particular stock. BRK is, I don't know, some of you guys might know, it's for the man himself, Berkshire Hathaway, Warren Buffett, the Oracle of Omaha. He's one of the best, if not the best value investors in history. He pretty much made the science based, his professor, Benjamin Graham, was the original guy, and Buffett and Munger, who was partner in crime, took it to another level. It's funny that another person I kind of begrudgingly respect is Elon Musk because he's just a crazy genius. He doesn't like Warren Buffett, but I don't think he likes Warren Buffett for the wrong reasons. I get what he's saying about Warren Buffett, that this guy just sits in a room all day and reads balance sheets and income statements. That seems boring. He doesn't really create anything, or he's not an inventor of anything. Yeah, Warren Buffett never pretends to be. Warren Buffett always says that what he does is very, very extremely boring. Right? He's never trying to pretend he's something he's not. Right? Nevertheless, I do give Elon Musk credit because he's a visionary. He's a visionary. Sometimes he goes a little off the rails, but I mean, Steve Jobs was a monster in some cases too. So I mean, the stories about that guy, but I mean, he brought out the best in his employees, and he really knew where technology was going. So, yeah. So, what is part C? Here, I want you to rerun. So what I'll do is I'll save this part. Actually, no, I can adjust both of them. What I want to do is I want to rerun instead of investing in the S&P/Y ETF as my benchmark. Let's say I invested in a particular stock. Let's say I invested in Tesla those 4 years instead of the market or the S&P 500, instead of the SPY. Then what would happen to my calculations? All right. So basically all I'm going to do, guys, is just take all this right here. To do this, it's a very simple change. Very simple change, guys. right? And I want you guys to do this as well. Don't choose the same ticker I did, you cheaters. Choose a different ticker and rerun your calculations. So here I'm going to do it for Tesla. Right, I get my Tesla one, and the fix is really simple. Changes from SPY to Tesla. I don't even need this part right here. Let's clean this up a little bit. All right, this is going to be Tesla as well. This is the same. This function needs to be rerun because my FPV value is slightly different now. Right, and now I run the value. Ooh, notice this error. Some of you guys have been getting this error, but again, we talked about this in lab 1. This error right here, f of function f parenthesis close parenthesis values at endpoints not of opposite sign. What does that mean? That means is this range you gave is not big enough. It's not wide enough. Let us see what the value for FPV was. Oh my God. Do you see that? The value of FPV is 144,000. How much money did we invest? 44,000. What does this mean? That means that the compound return is greater than 50%. Let's adjust this to 200%. Now it ran. What is my compound return, ladies and gentlemen? 53%, or 54% if you want to round up. 50-freaking-4%. Okay? This means that you should have not gone to college. This is a horrible example because you're like, oh, okay, yeah. Damn it, I shouldn't have gone to RBS. Screw you, Waj, right? 54%. What this means is that this is a equivalent of a savings account that gave an interest rate of 54% a year. 54% a year. So that every dollar you put in there, it keeps compounding at 54%. That is insane. Welcome to growth stocks. Tesla is a classic growth stock. It's a company that wasn't even making money. I don't think it's making that much money right now. Its operating income, I think, might be back into the negatives or very low positives. Nevertheless, its stock prices is shooting up exponentially. Why? Because, I mean, the simplest answer is because institutional investors, you know, those professional investment funds, corporate investment funds, a lot of these investors basically feel that this company will make exponential amount of profits in the future. Why do they feel that? Because they feel that Elon Musk, I mean, some people, like Mr. Wonderful from Shark Tank, he always keeps talking about, oh, it's a data company, it's a data company. Respectfully, yeah, a data company in itself doesn't really make that much money. Doesn't really make that much money. I mean, I shouldn't say that. Facebook and Google, all these guys are data companies. So, but with Tesla, it's very specific. With Tesla, it's not just about the data. That data is being contextualized to try to build a infrastructure of electric cars and batteries. More emphasis on the latter. The market feels, the people that really back Tesla and Elon Musk are the people that, look, Tesla's not a car company. And it's not really a data company too, like Mr. Wonderful said. It's really ExxonMobil of the future. Once Elon Musk figures out an efficient way to run those batteries and recharge those batteries from coast to coast of the US, what has Tesla effectively become? ExxonMobil. It's going to pretty much put ExxonMobil out of business. Because once they has that infrastructure, one, the technology of the efficient battery, two, the infrastructure to recharge it coast to coast, what happens now? Every car company, remember, they're all going electric. You just can't stop this. I don't care what Trump and his crew does with coal, right? You can't turn back the clock, right? In spite of these big corporations trying to kill renewable energy, it's not going to happen, right? So all these car companies are going electric. what's going to happen once Elon Musk gets there first, once Tesla gets there first? They're all going to start using his battery and his infrastructure. And when that happens, they're not doing that right now. Everybody's trying to build their own batteries right now. They're better batteries and infrastructure. Obviously, you guys know Tesla is like, I would say, one report I read, they're like 10 years ahead of these other companies. Some one report is like a few years, whatever. The point is they're ahead. And they can move much faster. Okay, they can pivot much faster. But if once Elon Musk wins this race, or statistically, if he wins this race, every car company will capitulate and start using his technology and his infrastructure. And once they do that, he's become ExxonMobil. Tesla, then it can be justified. Its value, its price value can be justified then. It can be justified, right? Because that battery and that infrastructure will go beyond just cars. And you guys see this in houses right now. The fact that people have solar, some people are buying the Tesla solar panels. They're kind of expensive right now to charge up their Teslas. So they have like a little ecosystem going, right? So it's not even their electricity from the grid that they're using, but they're using solar power to charge up their Tesla. So they're really becoming independent. And once you take this a step further, we can talk about using solar power to charge up the different houses. Once you take that one step further, neighborhoods, towns, cities. Once you take that step further, we're talking about a decentralized electronic grid, right? A decentralized system that's a lot more eco-friendly, a hell of a lot more cheaper in terms of utility prices, because it's all going to be renewable, aside from the tech. The tech is expensive as hell when you get that stuff installed. But it's decentralized. And by the way, it's safer because of the fact that the electricity grid becomes safer, decentralized at this point. So, but it has its own other risks. But anyway, that's why you see a 54% compound return. These companies like Tesla, they're rare, man. But these guys, I mean, they have like some fervent believers behind them. At the same time, they have a lot of extreme institutional and professional investors that feel that, listen, Elon Musk and Tesla is a big scam, and they short the hell out of it. I don't have to tell you which side is winning. So look, you guys can run this calculation back also for your hypothetical. For the rising seniors, rising juniors, you guys can run back this hypothetical situation where you invest in a particular stock. So don't use Tesla, use something else. Use a stock that you actually care about, a stock you're actually investing in the stock market game. All right, and this concludes our part B of our video. Hopefully this worked. You guys run back this lab, do it for yourselves, do it for a different stock. Check out the returns you guys got. And oh, the one thing I didn't show you, if I scroll back here to rising seniors, sorry. So here I have the tuitions, right? So if you do any summer sessions, what you could do is you can always pad it on to either the year you're ending or the year that's starting. In this case, because of the fact you guys are in the summer session, you guys could just add to your junior year tuition, whatever that junior year tuition is. You don't have to, because we don't have the senior year there. You can just pad it onto your junior year tuition. So that's what I wanted to show you. All right, guys, I'll post this code up. I'll post the video up soon. Thank you for tuning in, and I'll see you guys at the next Q&A and video sessions. All right, bye, guys.